So this fund is targeting an 18 to 22% gross return within the. I give you that range is because what we are targeting on the performing credit side is around about 12 to 14%, and what we are targeting on the equity side is an XIRR of above 25%. So when we do a mix of that, we're keeping a 10% range on allocation in terms of sometimes it could be 10% heavier on debt. Then in that case, we land up with 18%. In case if it is 10% more skewed towards equity, then you would probably land up with a 22% kind of a return.
Hello, my name is Vikas Agrawal and I am the founder of AIF and PMS Experts India. What we have observed is that there are more than 90% of the viewers in our YouTube channel who have watched our video and have been watching our video continuously at the regular intervals, but have not yet subscribed to our channel. So my submission to all of you is that please subscribe to our channel so that we can reach out to more individuals like you and spread the awareness about the whole investing game. Thank you so much.
So hello everyone, Avdhoot this side, Associate Vice President from AIF and PMS Experts India. Welcome to our show called name is Ask the Expert Show. Today we have Shantanu Awasthi ji with us. Shantanu Awasthi is the co-founder of MavenArk, a financial services firm that provides an arc of financial inclusion to small and medium enterprises and creates innovative possibilities for investors across asset classes. With over 23 years of experience in wealth management, he is an expert in designing and delivering customized solutions for ultra-high net worth families, single family offices, and institutional clients. He is also a seasoned leader and mentor who has built and led dedicated and robust teams in India and the Middle East, covering sales, products, and operations. He has been instrumental in establishing and growing the international presence and reputation of his previous employers like Clay Capital and Kavi Private Wealth, as well as contributing to their investment policies, asset allocation strategies, and research initiatives. He is passionate about creating value for everyone associated with MavenArk and leveraging his global expertise and network to the advantage of his clients. So welcome to our show, Shantanu ji.
Thank you. Good afternoon, everyone.
Yeah, good afternoon. So today we are going to focus on your product you have launched through MavenArk. So we want to know what is the core investment thesis of MavenArk Credit and Growth Fund Series 1. How does the fund balance between performing credit and growth investments?
Sure.
Over to you, sir.
Sure. So MavenArk Credit and Growth Fund is a unique mix. If I were to give you a parlance or some comparison about how it is positioned, so we have something in the mutual fund industry which is called balance advantage funds, which typically target to give you a regular income, but also look at an appreciation which comes out of the equity allocations. Now, when we were conceiving this idea, we had two things in mind. We were basically more focused on what the client wants and can we deliver it through a solution which in the private market in the AIF space. So when we started looking at, there were two basic demands which people wanted. People wanted a regular, predictable cash flow over a period of time. And for that kind of cash flow, most of the people usually go for fixed income instruments. And likes of fixed deposits or maybe bonds which they might be holding on of various maturities, and they try and get whatever income that can come from there. Now, unfortunately, for a fixed income investor who is actually investing, say, 100 rupees into a fixed deposit or a bond for maybe 4 years or 5 years, while he gets a decent pay, which could vary from 6-7% to almost 8, 9, 10, 11, depending on what kind of bond or what kind of fixed deposit he is holding. At the end of the tenure, when he gets his 100 rupees back, unfortunately, the inflation would have moved that value up to 160, and he's left with a 60 rupee loss in terms of the inflation value which is there. So the idea was that could we deliver something which could probably be gives a predictable cash flow for at least the tenure of the period for which the person intends to hold it. It could not be a very substantial cash flow, but a meaningful cash flow just around about the fixed deposit figures. And at the same point in time, at the end of the period, can one look at a capital appreciation which is above the inflation. So that was the idea when we were actually designing and conceiving this product. There were two things around it. Of course, you asked me the question about how do we balance it. So from a nomenclature perspective, this fund will always be 51% in minimum 51% in performing credit, where we are targeting a yield of around about 12 to 14%. And then the balance amount would be into equities, and equities will be a mix of both unlisted equities as well as some listed equities within that. A portion of listed equities just to rebalance the portfolio from time to time. It could be around 10 to 15%, and balance would be in the unlisted space. The fund is focused on BFSI, so the scope of investments is going to be in and around the banking financial services industry only.
Great. So, what is the typical investment horizon, fund horizon?
So the fund is basically from a final close, from the first close, it's a 6-year fund. So essentially, we expect as soon as we open it, maybe in a 2 month or two, we'll have the first close. And once the first close goes through, we intend to actually do 3 to 4 drawdowns, where we will be we are targeting 12 to 15 months of drawdowns. We have a decent track record in terms of deployment. So we had a 90-day track record of deployment of all our funds in the past also. So there is no chance of a dry powder or where we've taken the commitment value and we wait for a very long period. So we intend to actually do that within 3 to 4 tranches. And then post that, what we are looking at within that 6 years, from the fourth year onwards, we are looking at exits happening. So all the debt investments which are going to be in the performing credit side, the principal, there will be a regular payout of the bonds and interest, which will be passed on to the clients on a monthly basis on full deployment. And at the end of the period, as and when the maturities come, the money would be returned back to the clients. On the equity side investments, we are looking at exits from the 4.5 year onwards. We will start looking at exits within those. And as we make the exits, the money will be passed on to the client. So we intend to, return all the capital between 4th to 6th year. While there is a 1 + 1 year extension possibility, which we have also filed for, but we intend to kind of return the money before the 6th year, entire money back to the clients.
Okay, great. And what kind of returns we can expect from this fund?
So this fund is targeting an 18 to 22% gross return within the. I give you that range is because what we are targeting on the performing credit side is around about 12 to 14%, and what we are targeting on the equity side is an XIRR of above 25%. So when we do a mix of that, we're keeping a 10% range on allocation in terms of sometimes it could be 10% heavier on debt. Then in that case, we land up with 18%. In case if it is 10% more skewed towards equity, then you would probably land up with a 22% kind of return.
Okay, that means 20 to 22% we can expect.
Yes, and there will be a monthly, the debt portion, there will be a monthly payout. So if I'm talking about, say, for example, if we're talking about 18% is the so if I have 51% or 60% over there, so there will be a 5 to 6% per annum kind of a payout, which will be translates to around about 0.4 to 0.5% per month will be paid out to the client of the money. So for example, if there's a commitment of 1 crore, the client can expect 40,000 to 50,000 rupees on a monthly basis being paid out on full deployment. And in fact, in case the moment we make any of the private credit investments, the cash flow will start over there. So we intend to not park that coupons with us, but pass it on to the clients over there. So that will be, so if I'm talking about 18%, 6% would come like that, and the balance will come as capital appreciation, which will be around about 12% or so, if I'm just giving you ballpark figures over there.
Okay, great. Also, please throw some lights on track record of the fund management team in handling similar investments?
Fund management team has been there for, we have a stellar track record on the credit side. Our fund manager, which is our CEO, Mr. Fani Shekhar, he has been a debt fund manager since 2016. He launched the first performing credit fund in India. It had a gross yield of 12% plus through various crisis scenarios. We started with the demonetization, then we had the credit crisis, then we had the mutual fund crisis, then we also had COVID-1 and COVID-2. Throughout this phase, there was not a single default. It had a 12% plus gross yield. It had a debt mandate almost touching 900 crores plus, the portfolio which he handled. There was a monthly payout which used to happen there also. That monthly payout went on through and through. So from that aspect, he has a stellar track record. He comes with an equity background. So he started for the first 10 years, he was managing mid and small cap portfolios for Angel Broking at that point, which has become Angel One. And that was also a decent portfolio, delivered very good returns. And he has a fairly good understanding on the equity side. Then he made the shift in 2015-16, he made the shift from debt to equity, where he realized there was a huge demand within the client set, where clients were looking at something beyond equity and something which could give them regular and predictable returns. There was also a lot of uncertainty around the way, because people, the template which the debt fund managers or the mutual funds had set up was basically that of NAV going up and down, and multiple times FMPs were popular and people would not end up with the kind of NAV returns they were looking forward to. So people were more inclined towards more predictable returns, because when you give money, you give 100 rupees, then I'm looking at an X amount coming to me on an ongoing basis at regular intervals. And then beyond that, when my principal is due, one expects the entire principal to come through. So this was something which we saw was there, and everyone usually expects that, and hence we designed the first product like that, which was the debt fund. So from a experience perspective, on the debt side, since 2016 till now, almost till about a year and a half back, he had a track record in two places where he had managed the portfolio without a single default, without a single coupon being delayed.
Okay, great. So Shantanu, please tell us how this fund performs across the different cycles in the market, of the market.
So, see, I mean, from the debt side, of course, it has to perform through and through, irrespective of the cycles. So, as I cited, that the returns which came through, of course, through this period, you saw COVID wave 1, COVID wave 2, where equities also had a lot of volatility. Now, in the past couple of years, we've seen equity take a secular run. And before that, we've also seen different kind of equity not performing at that point in time, 2016, 17, till the time around about 17, 18 onwards, it started picking up. And if you see, there was a patchy this thing. From the fund's performance side, I will break it into two parts. First, I will talk about the private credit side, and then I will talk about the equity side. Now, when we talk about private credit side is essentially we are focusing on banking and financial services industry, and these are all balance sheet heavy businesses. When I say balance sheet heavy, means they are NBFCs who work like banks only. These NBFCs are mid-market NBFCs, very well established investment grade NBFCs. Their papers are floated out there. These NBFCs could be into gold loan, could be into affordable housing, could be into commercial vehicle loans, could be into SME, MSME loans, could be into two-wheeler loans, microfinance institutions, small finance banks, or different kind of institutions which are there. These institutions actually are very well regulated. They have to report their books to RBI on a regular basis. So it gives us an advantage in terms of looking at the entire book and understanding where the institutions kind of stand and which institution to give money to and which institution not to give money to. So it gives you, apart from the market insights. Second piece is this piece of NBFCs is very, very well entrenched with the India story or India growth story all in all. So when we talk about, what I am trying to talk about the real growth story, I'm not talking about the market story over here. What I'm trying to say is the GDP moving from maybe a $3 trillion to $10 trillion. Maybe it takes a decade or so whenever it happens, but that is a consensus story given our demographics, given our consumption, pent up consumption, which is there. And the main beneficiary of such kind of a growth would be the BFSI sector. And why I define so is, if you look at the BFSI sector's overall weightage in the GDP, it's almost 12% plus. And when we talk about, this is also a very, very well capitalized sector. It always reaches out to both debt markets as well as equity markets for its capitalization. And one of the significant points to note over here is almost BFSI has 35% plus kind of a weightage across all indices, starting from maybe if you talk about Nifty or you talk about BSE, Sensex, and all other indices which are there. If you look at within the India story, it is well entrenched. Secondly, India is a very unique country. It has some 50 to 60 lakh small businesses, and more than 60 lakh actually. And all these businesses on all these sectors in tier 2, tier 3 places, they all need capital for their growth. And India, while it has many sectors, it has oil and gas, it has IT, it has multiple things, but there's no dominant sector. The most predominant sector is basically the NBFC space or the BFSI space, which is basically gets the capital multiplier. So when you are talking about the growth story, this if you are talking about, say, for example, a commercial vehicle loan book with total would be around about 5 lakh, 6 lakh crores estimated, which amongst which Shriram Transport will be the most dominant player. Then you have the Mahindras and a couple of other players will be there. And this is growing at a 10 to 15% plus kind of a growth rate. So when you are talking about that kind of a growth rate, I'm just talking subsector wise, because overall growth also you can estimate from there. There are players like SK, which is only a 10,000 crores kind of a loan book size over there, operating out of a small region within India. So multiple such players are there, and they have a huge growth potential when it comes to catering to this whole growing space. Now we want to capture this space in two ways. On the debt side, as I mentioned, debt is not too much impacted by the cycles. It does get impacted by the cycles within the BFSI space, where you could see some slowdown in loans and other things. There it becomes more important of how the fund manager diligently kind of looks at various aspects of the company. Like, for example, corporate integrity, you try and measure that through the board structure, how well the company is actually following the rules around it, whether the company has high delinquency ratios or NPA ratios when it takes a growth. So there are multiple factors. You look at that it is well capitalized to kind of through any cycle like COVID cycle or other cycles, it is able to kind of pay off all its obligations. And that is precisely what happened in our case in the past, that we looked at companies with more than 25% plus kind of capital adequacy. So when the COVID wave 1 came in and COVID wave 2 came in, of course, the default rates increased. However, the companies were way above, because RBI mandates 15% capital adequacy. So they had a good buffer. They stopped lending, but they could recover their monies, and actually, as and when the COVID waves, the collection started, they could recover back and they could start lending again. So they were always there in the game, and they could commit and meet all their obligations. So this was one of the things we looked at. The other thing was always we were very focused on, because our CIO came from an equity background, he did not follow the standard template of debt. The standard template of debt was there is a AAA company. Beyond that, I don't want to look at other companies. And the growth, when we talk about that India will move from 3 to 10 trillion dollars, all this growth, all the money is not going to come out of banking sector, because banks will cater to X amount, and RBI and overall the government policies are also clear that banks sticks to working capital. Hence, this private credit growth will be actually financed by bond markets, corporate bond markets, and will be also financed by AIFs like us and other people who are playing in the private credit space. So it is a growing space. The expected gap would be around 60 to 70 billion dollars by 28 is what predicted by IMF and a couple of other reliable sources, what they are looking at within this, and CRISIL report is also around that. So it's a growing place. It might have problems, challenges in the interim. To pass through those challenges, we are focused on these few parameters which I talked about, and also from an asset liability mismatch perspective, we are more focused on that the tenure of the loan should be actually equal to it should money. Whenever I'm giving a loan and I'm borrowing from a bank, I should have that much that if I'm borrowing for 4 years, then I keep at least there are cycles two to if it's a quarterly loan or a half yearly loan or a monthly or an annual loan, then I am getting just 2 to 3 cycles or probably 10 cycles or whatever cycles where my money is being repaid again and again. So I can stop lending, but I'll not be in a situation like the way what happened in Diwan housing case, that they were basically borrowing for 1 year and they were lending for money. Home loan is almost 10-15 years. So when the market situation became bad, they could not refinance their borrowing. So in these kind of situations, what happens is they already have the money, they can always stop lending. So they are in the business. So it was an interesting aspect. It is called asset liability mismatch. We were very cognizant of this even before all these things happened. That's why we had that track record where we had. Also, the other thing is we are very cognizant of on the debt side when we look at while we look at the growth story, but what we are cognizant is when we give to a company should be making more money than how much it is paying you. So if we are comfortable with these companies because these companies which we look at are all growth companies. They are growing. They have been there for more than 5-6 years. They have an established book. They have raised a good amount of equity capital. They have ability to raise both equity and debt capital. So these companies again have a healthy margin. So maybe if they're borrowing from us at 13, 14, or from banks also, they are basically going and lending, and they have a net interest margin of at least 4, 5, 6% beyond their operations. So hence what happens is it gives you a substantial buffer, and that these companies are growth companies. So even if they're borrowing from you at 13% and they're growing and they have healthy margins, so they will not default on you. Of course, you have collaterals and other things in place. Those things are there, but given the India story, our lessons have been that you don't want to get into that situation. It is prevention better than cure. So that is the approach we take on the credit side. As far as the equity side is concerned, equity side is a slightly more, it's a growing space, and as I've been telling you about the whole credit growth side. Equity side has got two types of opportunities which are there. One is the balance sheet opportunity. So on the credit side, I'll be only looking at balance sheet businesses where they're borrowing money and lending money so that I am safe around it. When I talk about equity side has both balance sheet businesses as well as non-balance sheet, or what I call the fee income based businesses. So just to classify, fee income based businesses would be credit rating agencies, could be depositories, could be brokerages, could be asset management company, the mutual funds which are listed in the browsers. So all the other wealth management companies and all sorts of companies which are there, which are on the fee based side. They are not basically balance sheet heavy. What I mean by balance sheet heavy is basically that for a bank or for any NBFC which is in the lending business, it has to put its own capital, which is its own equity. At least RBI mandates 15%, which is called capital adequacy ratio. So you have to have at least 15, 20, 25% kind of capital adequacy, which has to be there. So on the equity side, we will be participating in both these opportunities. The good part is that since we also have a listed portion, wherever we get an opportunity, we will be definitely looking at deep discount over there. On the balance sheet business side, the opportunities, it's a very what we call the virtuous cycle of NBFCs. Typically, just to give you an example, say for example, there is a NBFC which runs a 2 to 3,000 crore kind of a loan book, and it has. So to run a 3,000 crore loan book, you would have at least raised bare minimum 450 crores of equity, or you would have raised 600 crores of equity over there. Now, once you have raised that kind of money, and you have to constantly, if you want to move from 3,000 to 4,000 crores, you have to actually raise 200 crores of more equity over there. The moment, say, this company raises 200 crores of equity, what happens is it can grow its loan book from 3,000 crores to 4,000 crores. Now, because you can leverage 4 times if banks will give you money. and your debt equity was better. So what these people would do is these companies would go back to their banks and probably bring down their lending rate from 15 to 14 or something like that, which will increase their net interest margin. And simultaneously, the book size also increases. So when the book size increases, then you multiply both of them. There is a high chance that the credit rating agencies give them a rating upgrade. So if it was a triple B plus company, it could become an A minus company, or A minus company could become a A or double A company, or depending on those rating upgrades which happen over a period of say 3 years, 4 years. Now these rating upgrades, as and when they happen, they help because both on the debt side as well as on the equity side. So on the debt side, of course, you don't have any defaults because it goes through rating upgrade. On the equity side, it's very simple for you and me to understand. If there is a rating upgrade, as and when there's a rating upgrade, there's always a upside on the equity also, equity valuations. So what we have witnessed in the past through these periods, I mean, last 10 years have been pretty turbulent, both from equity and debt perspective. Debt, I have already given you the track record. On the equity side, interestingly, this whole space of, whatever sectors I talked about, whatever NBFCs I talked about, while there has been an equity participation on the private markets, but a lot of these companies have hit the public markets. Like I can give you examples: Credit Access Grameen, Bandhan Bank, you've seen AU Small Finance Bank, you've seen multiple such companies hit the equity markets also. But on the private side, when they were raising equity, not many, it was purely institutional equities. So institutional equities, I mean foreign portfolio investors who invested their equity in the private markets, and then domestic institutions like ICICI and other large institutions who invested this money in their own balance sheet. Unfortunately, this all got absorbed in those balance sheets, but it never came to the non-institutional place. So the HNIs, UHNIs, through whatever mutual funds or AIFs or PMSs, never got that participation. Maybe AU Small Finance Bank, one participation would have come from Motilal. But beyond that, very limited number of cases where you've seen that. However, there are a bunch of companies. I can give you a list of at least within our portfolio, we've witnessed some 17, 18 companies which we had given money to. They all constantly raise equity. So their returns on equities on an average has been more than 25%. And these are not companies which will have funding winter or any challenge. They have a traditional valuation methodology. They are profitable mid-market companies. And simultaneously, if we talk about, there are other significantly around at least 35 plus companies which we have identified, which also on an average have given more than 25% XIRR in terms of equity valuations. Either there's some of listed, some not listed, then the last rounds they raised equity in. So you have all the reportings everywhere and you will be able to, it was quite surprising. And on the equity side, we believe that while the story of India remains intact, there could be ups and downs, and there could be also things, but this sector is going to be main beneficiary in the coming times as well, and hence we are targeting a 25% plus kind of a return over there.
Okay, good to hear some important points from your side. So Shantanu ji, we will also like to know the fund structure and the terms also.
Sure. So this is a category 2 AIF. The fund structure as the construct is, it will be always 51% bare minimum into private credit. It could go higher than that. Maximum equity participation could go up to 49%. It could be lower than that. So depending on opportunities and how and when the opportunities come, when we draw the monies, the allocations will be made. As far as the fund structure is concerned, fund will be basically, we look to do a drawdown between 12 to 15 months from the first close. Post the drawdown, within this drawdown, we look at 3 to 4 calls, amongst which we will call the entire amount. First drawdown would be 30%, and then subsequently it will be remaining 70 will be called between 3 to 4 calls. And within a period
4 calls between
15 to 15 months. 12 to 15 months.
Okay.
So you can have on an average expect a call on 2.5 to 3 months basis. And it could be, if we could, I mean, we'll try and finish it off within a year itself. So that is how the fund would work. The fund is got a lock-in. So it's got a 6-year lock-in. However, once the funds are fully deployed, there is going to be a payout of 0.4 to 0.5%, which will go to the client on a monthly basis. There'll be a monthly NAV. This monthly NAV will go through because we are making monthly payouts also over there. Our tax auditors and our tax consultants, advisors are BSR, which is basically KPMG in India. And we are looking at a 300 crore plus 300 crores green shoe. So we're looking at a total fund size of 600 crores with the green shoe. And the commitment period is basically 6 from the first close. And after that, 6th year on, by 6th year, we want to kind of give the entire money back. There is a 1+1 extension which is filed in within the PPM. So that's more or less. Anything else you want to know about the fund structure? I'm more than happy to do.
That's more than enough. That's more than enough. Also, please show throw some lights on the opportunities exist in private credit and SME lending in India. What will be the expected growth in microfinance, SME financing, and housing finance too?
So interesting thing is, this is a very interesting thing. I don't know what I am talking about here, but I'll just give you an example. See, both if you would have read the newspapers and you would have read some news flows which have been coming, whether it is it started with the microfinance institutions, and it has continued to say some small other businesses, secured businesses also. There is some stress at that strata where there has been basically the numbers have not been coming good in terms of, and that is where we've seen a few companies, one of the companies got rating downgrade, and there are other opportunities over there. So what essentially this has given is giving, and what we believe is it will take around about, this is not something new. These bigger crises than this kind of a crisis have happened in the past. We've seen COVID and other things. The industry is not going to go bust. Industry is going to grow. It's just a business cycle which comes in. And the good part about this business cycle is that while this is happening, there are multiple such companies which are available both on an equity perspective as well as from a private credit perspective, where you are able to, if I were to actually start this fund maybe a year back, it would have been difficult for me to target 12 to 14% return. I would have been probably 10, 11, max to max 12. But given the opportunities the way they are at this point in time, we can easily look at returns between 12 to 14% and such opportunities coming in. When we talk about this, we believe while this pain is there, it has been continuing for some time. The good part is that the lending has stopped. A lot of these companies are not lending any future money. The reason for this whole stress was because there were some changes in the RBI policy and in the microfinance institutions or that strata when you're looking at two-wheeler, three-wheeler, they were over-leveraged because a lot of these companies went aggressively and they lent to the customer where he didn't have the payment capacity. Now that the lending is stopped, we expect the cleanup to happen, and as the cleanup happens, it might take maybe 2 to 3 quarters before the cleanup happens and the next round of growth starts kicking in. The interesting part about this is that the strata, when we're talking about the strata which is buying or getting these loans, whether it is microfinance, whether it is two-wheeler or it, most of these people they have only two options. They have one option which is the traditional source of borrowing. Traditional source of borrowing, unfortunately, does not have dignity or does not have predictability around it. Whereas these small finance banks and other institutions, there is a proper amount of predictability and this there. And this data is never out because they will always have their income levels are there, but it is not that they're borrowing to increase their income levels to the next level, but they will always have obligations within their on the financial side, whether it is daughter's marriage or ex or school fees or other things. So they will have to come back to this market to borrow again. And they are also very cognizant about, you will be surprised that the credit data actually throws very interesting perspectives. Entire pool of people who are actually there available within the country. Rural Bihar rates as the most safest place from a microfinance institution. On the contrary, you would think that why would that happen? But that is the case because most of these places, India has a very high home ownership ratio. And so urban places is different, but as the moment you move towards tier 2, tier 3 or beyond, or you go to a village, in village there's 100, nobody lives in rented houses, or smaller places, they all have their own place. So hence the communities are very, very strong. So XYZ, that is good from an institution's perspective, because you have all the information about what the behavior, and community gives you entire understanding, so you can build a underwriting around that thing. And secondly, because of the person is not going to go away anywhere, it becomes easier for you to look at. So when, since you asked about commercial vehicles and you asked about microfinance, interesting aspect over here is when you look at microfinance institutions or you look at commercial vehicle. In fact, you would believe that commercial vehicle is safer, right? Because you have a vehicle which is there and it is easier. But unfortunately, there are two sets of data there. One is the commercial vehicle which is running within a perimeter of a city or something, a town. Other is which is going across states or probably traveling to different places. Now, when you are talking about that commercial vehicle space, the person is not returning to home every day. So there the default ratios are higher, right? And whereas when you talk about the commercial vehicle where the driver is working within limits and going back to his home, there the default rates are lower. So these are very interesting statistics on which the entire piece of lending works. From a traditional banking point of view, of course, collateral is the best, and one of the best collaterals available over there is either the affordable housing or the gold, which you can look at. So we are not ignorant on, I will be on this side or that side. Wherever we find decent opportunities, decent security, we will definitely be looking at those opportunities around.
Okay, great. One last question, Shantanuji. In very simple term, please explain us how this fund is better than mutual fund or FD product.
Sure. So the interesting part is, see, if you are a debt investor and you are looking at investing your money, and just repeating that point, you are, say, investing 100 rupees. At the end of the period, you're getting 100 rupees back, and whatever interest you were getting, 6, 7, 8%, you kept getting it. Unfortunately, you took that interest and used it. When you are looking at inflation, the value of that should have been at least 160 after 5 years, which is not the case. So as a debt investor, this will give you a regular payout, and this will also be giving you at least 15, even if you get, say, 16% or 17%, in that case also, if I have 6% is paid off, 10% or 11% would basically beat the inflation. So your value would be protected in simple terms. If you are an equity investor, the interesting part is that equity has a lot of volatility, right? We know that we had a good run. Now we are having a very volatile time in the equity side. So while equity pays off in the long run of 5 years, there could be a volatility which you have to deal with. And you are all investors, so you understand that you want to kind of stay put over there. At the same point in time, the other problem with equity is that you don't get any regular flows coming to you on an ongoing basis. So, you have to, if the markets are on the wrong side, then you have to wait it through to get some kind of money. So if someone on the equity side, given what the market situation is, you made a good returns, and if you want to diversify and look at a bracket where you can get more than 15% away from public equity markets, you can probably participate in this, because it is all private market fund. Essentially, if I were to compare, you have something called balanced advantage funds, which are there in the mutual fund parlance. So this is comparable to that. The only good part is, while mutual funds on the debt side would probably be only able to deliver 7, 8%, not more than that, this will probably look at 12 to 14% on the gross side on the debt. And on equity, while the mutual fund would probably look at a 15, 16 to 20%, it probably look at a much higher return than that, in the 25%. So the lock-in or the time which you're giving over there, you have a regular flow within that phase. And when you are looking at 5 years down the line and comparing it, and you want to look at returns, you can expect a target return of 18 to 22, which could come within that range. So from a simple perspective, it gives you a payoff, and it also protects your capital value. Since it is private market opportunities, this is different from mutual fund. It is a diversification for you. It is also at the same point in time meeting all your needs, and it is not like a private equity, which could probably have companies going bust or some companies becoming unicorns. It's a more stable equity where you're probably looking at a high bracket equity returns, and very close to traditional markets.
Right. Great. It's great. It's thank you so much, Shantanu ji. You have shared almost all points about MCG Series 1, and you have given some valuable information to our viewers and investors also. So with this, I would like to conclude our session today, our today's show's Ask the Expert show. Thank you so much, Shantanu ji. Thank you so much for your valuable time.